The IKEA Business Network is now open for small businesses and entrepreneurs. Join for free today to get access to interior design services to help you make the most of your workspace, employee well-being benefits to help you and your people grow, and amazing discounts on travel, insurance, and IKEA purchases, deliveries, and more. Take your small business to the next level when you sign up for the IKEA Business Network for free today by searching IKEA Business Network.
This is Optimal Finance Daily, One Big Expensive Investing Mistake to Avoid by Delaworth with MoneyMiniBlog.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get right to it as we optimize your life. One Big Expensive Investing Mistake to Avoid by Delaworth with MoneyMiniBlog.com. These days, you can get started investing online with only a couple of dollars. And the whole process of creating and funding a brokerage account can usually be done from your couch, even if you only have a few minutes to spare. So at the end of the day, it's fair to say we're extremely lucky to live in this era of unparalleled and ever-increasing financial access. But unfortunately, especially for newer investors, investing itself isn't quite as easy as opening your account. In fact, it turns out there are a myriad of different ways to lose your money in financial markets. And unfortunately, common sense doesn't preclude us from many of the common investing errors. Some of the more popular mistakes you might be wary of include: Number 1, don't buy stocks on a tip. Just because your friend, colleague, or favorite uncle is making an investment doesn't mean it's a good one. If you habitually buy companies based on a hot tip, you're basically gambling with your hard-earned savings. Stop it. Number 2, buying too much of one investment. This is another risky proposition, and not only is it financially perilous, it can also be immensely stressful to put all of your eggs in one basket. You might even find yourself tossing and turning at night, afraid of what you might wake up to. And number 3, trading too frequently. Even though trading stocks online is easy, and some would argue fun, don't get carried away. Because each time you place a trade, you open yourself up to a potential mistake. Plus, if you aren't careful, you'll find the commissions can really add up to take a bite out of your bottom line. Now, while you should certainly pay attention to these common investing errors, and as insidious as they can be, there's one much larger mistake you'll definitely want to be aware of. So what is this big and expensive investing mistake to avoid? Let me show you. Why not having an exit strategy will cost you. Most investors start out with the very best of intentions. They want to put their money to work with the hopes of saving for a down payment on a house, putting their kids through college, or simply having enough left over to enjoy their golden years. But one thing many self-directed investors seem to continually gloss over is how and when to sell the securities in their portfolios. And it doesn't matter what your time frame is or what kind of assets you buy. In every case, you should be able to articulate why you'll sell before you ever buy. Because chances are, at some point, you're going to want that money. So you had better have some rules around when you can access it. The reason this is so important is because without a logical and well thought out exit strategy, you open yourself up to huge risk. You're more likely to sell at the worst possible moment, which can cripple your financial future and seriously set back any ambitious plans you might have had. And even if you do stay the course, you might find the journey much more stressful when you're perpetually second-guessing yourself. So if you're curious about how to come up with an exit strategy, keep listening. How do you decide when to sell your investments? Unfortunately, I think deciding when to sell is the absolute hardest part of investing. On one hand, if you have a losing stock pick, ETF, or mutual fund in your account, you're probably worried about how much lower it can go. So will you cut your losses or stay the course? And what if it rebounds higher after you sell? On the other hand, deciding when to sell winning investment ideas is also a difficult decision. Do you take your profit or leave some money on the table with the hope that your good fortunes will continue? What if it keeps going up after you sell? These aren't easy questions, and the answers are very likely to depend on your personal investing philosophy, risk tolerance, and time frame. But at least by starting to be aware of these factors, you can begin to reflect on your specific selling options. So I strongly encourage you to think about the circumstances under which you'd sell. This is especially true if you're buying and selling individual stocks. In my experience, the biggest losses come from betting on a specific stock or company and riding it all the way to zero. So if you're a fundamental investor, think about what data would need to change for your thesis to be proven wrong. And if you're a shorter term trader using technical analysis, decide where to put your stop loss ahead of time. Here's another example. If you're a buy and hold investor building a diversified portfolio for retirement, be very clear how much you need to accumulate before you'll start selling down. And remember, this dollar amount can change in the case of a market drawdown. Thus, you may need to adjust accordingly on the fly. Plus, think about what other external circumstances could compel you to sell. What sort of family emergencies or unforeseen events would cause you to cash out your investments? Or what rate of return would you need to see from a hot real estate deal to liquidate your stocks and move to an alternative asset? By laying out these rules ahead of time, you should be less likely to make an expensive emotional mistake and sell at the wrong time. As for me, in my case, as a trend-following investor, I've written out a detailed plan for where to place my stop-loss order and how to adjust it over time. Then, in my longer-term retirement accounts, I'm happy to continually dollar cost into diversified low-cost funds, rebalancing periodically to get back to my target allocations so long as my businesses are generating cash. Now, the key is to just stick with these good intentions. Conclusion: the right time to sell is up to you. As you can see, there are a variety of factors that go into deciding when you should sell your investments. So I encourage you to take some time to reflect on your personal situation and what exit strategies will work best for you. But whatever you do, just make sure you have a plan for when you'll sell, and do it before you push that buy button. It's the only way to consistently avoid the biggest investing mistake out there. You just listened to the post titled, "One Big Expensive Investing Mistake to Avoid" by J. Delaworth with moneyminiblog.com, and I'll be right back with my commentary. For a lot of people, myself included, different finance apps can be stressful and make it difficult to manage finances. But then I tried Monarch Money and everything got so much easier. Maybe you're saving for a down payment, a wedding, a dream vacation, your kids' college. I found that Monarch makes it so easy to help you reach your financial goals, whatever they are. I definitely wouldn't be able to allocate my finances or plan as clearly without help from Monarch. In fact, Monarch is the top-rated all-in-one personal finance app. It gives you a comprehensive view of all of your accounts, investments, transactions, and more. Create custom budgets, track progress towards financial goals, and collaborate with your partner. And now get an extended 30-day free trial when you go to monarchmoney.com/OFD. After trying out Monarch for myself, I understand why it's the top-rated personal finance app. And right now, listeners of this show will get an extended 30-day free trial when you go to monarchmoney.com/OFD. That's monarchmoney.com/OFD for your extended 30-day free trial. I often hear a lot of confusion about what to actually buy when you're investing, and this article highlights some considerations for stock picking if you're an active investor. If you've been listening for a while, you know that I'm a huge fan of passive investing in low-fee total market index funds. And if you're interested in learning more about this style of investing, I recommend you read The Simple Path to Wealth by J.L. Collins, because that book is what helped me figure it out. While it's true that active investors are more likely to beat the market in the short term, almost no one beats the market over the long term, unless you're Warren Buffett. That's a big reason why I'm such a fan of passive investing. I just don't see the need to work harder when the results likely won't be better. And because I'm investing for the long term, I simply don't need to beat the market. I'm happy with matching the market to meet my financial goals. When it comes to an exit strategy, I do agree with the advice here that you should have a financial target in mind for retirement. Once you reach this goal, your strategy in terms of asset allocation can shift from accumulation to preservation. As my friend Frank Vasquez says over on the Risk Parity Radio podcast, once you win the money game, there's little benefit to keep playing. But that should do it for today. Have a happy rest of your day, and I'll see you on the Tuesday show tomorrow, where your optimal life awaits.